Have you ever used a service that felt, well, almost magical? Super convenient, simplifying your life.
Yeah.
But then you get that little nagging thought. What's the real cost here? What do you actually know about the hidden price tag behind that convenience? Today, we're diving deep into exactly that, Uber's long, often pretty controversial journey towards profitability. Our main source for this session is a really detailed investigative expose. It's called How Uber Really Made a Profit. It basically dissects their finances, their market tactics, which were aggressive, and, the big economic trade-offs involved.
Right. And our mission here is to pull out the most important pieces, the key insights from this material. We want to help you understand not just what happened with Uber trying to make money, but maybe more importantly, why it matters for everyone involved and what the true cost really was behind those profits they chased for so long.
Okay, so the source really focuses on Uber's basic strategy, right? A classic Silicon Valley growth at all costs model. From that expose, what's maybe the most striking example of that mindset in action, that growth at any cost approach?
Well, it's pretty stark how aggressive they were early on. I mean, Uber often just started operating illegally in cities all over the place. They were essentially betting that they could get so big, so fast, that the regulations just couldn't keep up. The attitude seemed to be very much, look, we'll deal with the legal stuff later, after we're already everywhere and people depend on us.
And the speed of that expansion was just, wow. Started with one ride, San Francisco, 2010. By 2013, they're in 74 cities, valued at, what, $3.5 billion?
Yeah,
That's faster than almost anyone.
Oh, absolutely. Way faster than most established tech giants in their early days.
Then just 3 years later, 2016 rolls around, they've raised $7 billion in funding, and boom, a $51 billion valuation.
And that whole strategy, it kind of culminates in their 2019 IPO. Huge valuation, $82 billion. But here's the kicker, the really crucial detail. Uber goes public even though they'd lost over $10 billion in the 3 years before the IPO. That wasn't just like an accident. It's the perfect example of that Silicon Valley playbook,
Yeah.
Bleed cash like crazy, get enormous scale, and just assume that profitability will sort of magically happen later on once you're on the market.
Right, that assumption.
Yeah.
So once they felt they had a grip on ride-hailing, they started looking around, where else can we go? They didn't stop with rides. They used that same infrastructure, the app, the drivers, and jumped into food delivery. Started something called Uber Fresh, then became Uber Eats in 2015.
Yeah, and a really key moment here was COVID-19, the lockdowns. Suddenly, Uber Eats wasn't just convenient, it became, well, essential, almost overnight. Restaurants became incredibly dependent on the app just to reach their customers at all.
A lifeline, basically.
For many, yes. A lifeline for businesses shut down from dine-in.
But, like we were saying, there's always a cost. And this lifeline came with a pretty significant hidden cost for the restaurants themselves. Uber Eats was charging commission fees, sometimes 30, even 40%, which, for a small restaurant barely hanging on, that's often just unsustainable.
Exactly. It got so bad in some places that city governments actually had to step in. They passed laws to cap those fees, which is basically the government saying, whoa, these rates are potentially predatory.
Yeah, a clear signal.
And here's the real irony. Even with this massive surge in food delivery because of COVID, Uber still lost money overall in 2020. Why? Because their main business, ride-hailing, just collapsed while everyone was staying home. It just shows you what a tightrope they were walking financially.
Which brings us, I think, to the core argument in the source material we looked at. The argument is that Uber's eventual profitability didn't really come from some amazing new efficiency or innovation. It came mostly from, well, cutting corners and, as the expose puts it pretty bluntly, exploiting its key stakeholders.
That's right. Let's zoom out a bit. The impact on drivers, for instance, was pretty stark according to the sources. We're talking median pay often falling below minimum wage for a lot of drivers. Back in 2018, the estimate was around $8.55 an hour, and that's before taxes. Some drivers, after you factor in gas, insurance, car maintenance, they were actually losing money.
Losing money to work.
Yeah. And this isn't just about Uber, It really highlights that fundamental tension you see in the gig economy. Who's actually carrying the risk and the real cost of all this convenience we enjoy?
Okay, wages did go up a bit by 2022, but that was mostly because governments were putting pressure on them. But the negative trends didn't stop. The source points out Nashville drivers facing a 20% pay cut just this year, 2025. And nationally, overall driver earnings actually fell by about 3.4%. It really sounds like a constant struggle for a lot of them.
Definitely. And it wasn't just drivers feeling the squeeze. Let's talk restaurants again. The article gives this really concrete example. A pizzeria does $1,000 worth of orders through Uber Eats. After Uber takes all its fees, the restaurant gets back only about $330. Just think about that margin.
Wow. Less than a third.
Yeah, and it perfectly illustrates Uber's strategy, right? Keep prices low for the users, make it attractive, but then extract as much value as possible from the suppliers, the drivers providing the rides, the restaurants providing the food. It's a way to win market share for sure, but it puts a huge burden on everyone else in the system.
Unsurprisingly, this kind of aggressive approach and the impacts it had kicked off a huge wave of legal challenges and ethical questions about Uber, like all over the world.
Oh, absolutely. We started seeing specific laws trying to push back, trying to protect workers and consumers. For instance, Oregon had Senate Bill 1166 that proposed minimum wages for drivers, paid sick leave, trying to create a basic safety net.
Things gig workers usually don't get.
Exactly.
Right.
Then Colorado brought in a safety bill mandating background checks for drivers every 2 years. That was focused on public safety. And Washington State tried to pass a surge cap bill to limit how high surge pricing could go during peak times, protecting consumers from those crazy fares.
And what was Uber's typical reaction when these kinds of regulations popped up?
Resistance, mostly, sometimes outright defiance. The source mentions threats to just pull out of cities entirely if these laws passed. It created this constant battle, this tension between the company wanting maximum flexibility and local governments trying to protect their citizens and workers.
Right, a power struggle.
And another really controversial point the source brings up, Uber counting tips towards meeting minimum pay requirements in some places, which basically means the tip you think you're giving directly to the driver as extra.
Might just be subsidizing Uber's wage obligations.
Precisely. It can really undermine the whole point of tipping and effectively lowers the driver's actual earnings. It shifts even more cost, subtly, onto the consumer.
Okay, so after all this turbulence, all the losses, the legal fights, finally the source confirms Uber did hit profitability. We're talking real numbers, $2.3 billion in profit in 2023, $4.1 billion in 2024, and they're projecting maybe $6.1 billion in 2025. Seems like they finally made it, right? The goal was achieved.
On paper, yes, the black ink arrived. But these numbers definitely come with some pretty big asterisks, some major caveats. First off, Uber's still carrying a lot of long-term debt, like $9.3 billion.
$3.3 billion, wow.
Yeah. So to put that in perspective, even with those projected profits, it would take them roughly 4 years of their 2023 profit level just to pay off that existing debt. So it definitely raises questions about the true financial health of the company, even with those headline profit numbers.
And what about the investors, the people who poured money in for years? They raised something like $33.5 billion in total funding. What kind of return have those investors seen?
Well, the source suggests it's only been about a 5x return overall.
Only 5x.
Yeah.
For a company that was supposed to change the world, a massive disruptor. That actually sounds kind of unimpressive, doesn't it?
For venture capital, especially for a company with Uber's profile and initial hype, yeah, 5x is generally considered pretty underwhelming. Many early backers were hoping for much, much more. So when you put it all together, the sort of core insight from the expose seems to be this. Yes, they achieved profit, but it was gained mainly by shifting the financial burden, pushing costs onto the drivers, onto the restaurants, and even, you could argue, onto cities dealing with the regulatory battles and infrastructure strain. It looks a lot like value extraction rather than value creation for everyone.
Okay, but there's another twist in the story, right?
Yeah.
Just as Uber is finally getting profitable, the ground is shifting under their feet, especially in food delivery. It turns out that Uber Eats' crown, it's actually slipping.
Yeah, this is really interesting. The market share figures are quite telling. Uber Eats has like 26% of the U.S. food delivery market right now, which is decent, but DoorDash, they command over 60%.
Over 60. That's dominant. How did DoorDash pull that off? How did they beat Uber at its own expansion game, essentially?
Well, the sources point to a couple of key things DoorDash did differently. First, they apparently focused really hard on underserved markets, especially suburban areas with high growth potential right from the beginning. Uber was maybe more focused on dense urban cores initially.
So different geographic focus.
Right. And second, DoorDash seems to have implemented dynamic pricing and just tighter operational discipline much earlier on. They were thinking about profitability from day one, it seems.
Unlike the growth at all costs model.
Exactly. DoorDash's path was different. They reported smaller losses historically and actually reached profitability faster than Uber Eats did. It suggests DoorDash didn't just get lucky. They arguably outmaneuvered Uber in the food delivery space by playing a smarter, more focused, and maybe more profit-conscious game from the start. It shows there was another way to build that business.
So bringing all these different threads together, we end up with what the article calls the paradox of Uber's success. And it's framed very much as a kind of zero-sum win, meaning for Uber to finally win profitability, others sort of had to lose out.
Yeah, that's the core argument. And you have to ask, well, who lost in this model, according to the source? The picture painted is pretty clear. Drivers often making less than a living wage, restaurants losing huge chunks of their margins on delivery orders, potentially local economies being destabilized by the disruption, governments having to constantly fight regulatory battles, and even investors, as we said, maybe feeling a bit wary about the actual long-term returns despite the recent profits.
So the article's conclusion is pretty stark. It argues that Uber's model, at least as presented here, is built more on extraction taking value from others than on symbiosis, where everyone benefits together. And it raises the question, is that extractive model actually sustainable in the long run? Or is it inherently fragile?
It's a tough question.
Reflecting on this whole journey through Uber's finances, it really highlights that there's a massive difference between just hitting a profit number on a spreadsheet
Yeah.
and achieving what you might call truly sustainable, maybe even ethical success. It's a journey that definitely makes you think twice about the hidden engines driving our everyday convenience.
Absolutely. And maybe that leaves a final thought for you, the listener, building on what we've discussed from the source material. If Uber's path to profit is a case study in, let's say, aggressive capitalism bending rules, exploiting gaps, shifting costs, then the real question isn't just whether Uber won in the end. It's more about at what ultimate cost. The cost to the drivers, the restaurants, the cities, the whole ecosystem. And maybe even more importantly, what does the story imply for the next wave of innovations, the next convenient service that pops up in our daily lives? What should we be looking out for?